everyone, welcome back to the channel. I'm Sebastien Boyer, the Approved Guy. We're going through our video series of interviews with Denise Clemence, Conversations with the SBA Queen. This particular video, I'm asking her the question, what is debt service coverage ratio? What is DSCR? This is a very important aspect of preparing your finances to be qualified for funding, and so she's going to answer that question. Please remember, guys, if you need a consultation or you're interested in applying for an SBA loan, make sure you reach out to me directly. We'll have a link in the description. Please make sure you subscribe, like, and share this video. Without further ado, let's hear what Denise has to say about debt service coverage ratio.
Debt service coverage ratio is the ability for the business to pay its debt and to remain with a profit. So typically lenders want to see above a 1.25, which means that for every dollar, you've got 25 cents in profit. And the way you succumb to this number is you're looking at the profit. You would add back interest, depreciation, one-time expenses, if there are any. When you're doing a business acquisition, we add back the old owner's salary and we take out and compensate for a new owner's salary. And whatever that is at the end, when you add it up, you balance it against the existing debt, and that would give you a ratio. But what we're looking for is that it can service the debt. Most lenders are looking for a historical of 2 to 3 years of debt service coverage. Because 2020 was an abnormal year, and many companies, not all, but many companies did survived a shutdown and did show a very big dip. So when that happens, we're really leaning and weighing on 2019 and 2018. And now that we're in 2022, we're going to want to see those 2021 tax returns to see that they bounce back after COVID and that they've reopened and are able to move forward with a profit. But it's really just looking at understanding, can it pay the debt? And can you still pay yourself and make a profit?
Thank you for
who wants to buy a business that's not making a profit?
Of course, yeah. We're all in business to make money, right? Otherwise, we'd just be hanging out, sipping something on the beach somewhere.
Exactly. When I see it a lot in, let's say, bed and breakfast or small hotels, they're like, but the real estate is worth it. I understand the real estate's worth it, but if you can't pay the debt, why would you buy it?
Right.
Unless you've just got money to throw away.
Right.
So, and that's what happens with a lot of these, like I said, sometimes bed and breakfasts are considered like hobby businesses. They don't necessarily show a profit. And I'm not discounting the value of the real estate. I'm just discounting the fact that they would be able to pay the debt based on the way the business is currently being run. And we're not, as an SBA lender is the largest investor in a company, right? So on a business acquisition, the borrower is putting in 10, maybe 20%. We're doing the other 80%, maybe 90. We're the largest investor. We have the right and we have the duty to the SBA to make sure that they can repay their debt. Sure. And if they can't, and they don't have outside income that's going to pay this debt, why are we going to lend the money?
Of course.